Innovation in Banking. Part 3. Basel Norms, AI in Banking and Blockchain. BBA, BCU. Riaz Notes. Basel Norms, Meaning and Objectives. Meaning. Basel norms are international banking regulations made by the Basel Committee on Banking Supervision, BCBS, a body of central banks, to ensure banks hold enough capital to handle financial risks. Word: Basel is a city in Switzerland where BCBS is headquartered. Norms means rules. So Basel norms equals international rules made in Basel to make banking safe worldwide. Objectives: ensure banks maintain enough capital to absorb unexpected losses. Promote stability in the global banking system. Create a level playing field, same rules for banks in all countries. Also, reduce the risk of bank failures that could harm the wider economy. Encourage banks to identify and manage all types of risk systematically. Basel I, 1988. Meaning, Basel I, introduced in 1988, was the first international banking regulation. It focused on credit risk, the risk that borrowers won't repay, and set a minimum capital adequacy ratio, CAR. CAR requirement, minimum CAR of 8%. Formula: CAR equals capital divided by risk-weighted assets times 100. Meaning, for every 100 Indian rupees of risk-weighted loans, the bank must hold 8 Indian rupees as capital. Risk weights: 0% for government bonds, safest, 20% for bank claims, 50% for housing loans, 100% for corporate loans, riskiest. Higher risk equals more capital needed. Limitation: Basel I only covered credit risk. It completely ignored market risk and operational risk. This was its biggest flaw, which led to Basel II. Basel II, 2004, 3 pillars. Meaning, Basel II, 2004, addressed Basel I's limitations. It introduced a more detailed, risk-sensitive framework built on 3 pillars. Pillar 1, Min Capital. Banks must hold capital for credit risk, market risk, and operational risk, not just credit risk as in Basel I. Pillar 2, Supervisory Review. Regulators like RBI can review and require banks to hold extra capital based on their specific risk profile, beyond the minimum. Pillar 3, Market Discipline. Banks must publicly disclose risk exposures, capital levels, and risk management practices so investors and the public can assess them. Limitation: Basel II was not strong enough to prevent the 2008 global financial crisis, leading to Basel III. Basel III, 2010-11. Meaning, Basel III was introduced after the 2008 financial crisis revealed banks had too little capital and too much debt. It set much stricter capital and liquidity requirements. Higher capital, minimum common equity tier 1, CET1, ratio equals 4.5% of risk-weighted assets. Total capital requirement equals 8% plus 2.5% capital conservation buffer. Liquidity ratios, LCR, liquidity coverage ratio, hold enough liquid assets to survive 30 days of financial stress. NSFR, stable long-term funding to match long-term assets. India, RBI has implemented Basel III norms for Indian banks in phases. Leverage ratio minimum is 3%, a non-risk-based safeguard against excessive borrowing. Importance of Basel norms. 1. Financial stability. Ensures banks can absorb losses, preventing failures that harm the whole economy. 2. Investor confidence. Basel compliance makes investors and depositors trust banks more. 3. Global uniformity. Same safety standards for banks across all countries, no regulatory shortcuts. 4. Risk management. Forces banks to identify, measure, and manage credit, market, and operational risks. 5. Crisis prevention. Rules tightened after each crisis, I23, help prevent future crises. 6. Protects depositors. Strong capital means depositors' money is safer even if the bank faces trouble. AI in banking, meaning and opportunities. Meaning, AI in banking means using computer systems that can think, learn, and make decisions to improve services, reduce costs, and manage risks better. Word: artificial equals man-made. Intelligence equals ability to learn and decide. So AI in banking equals computers doing tasks that normally need human intelligence applied to banking. Fraud detection. AI scans thousands of transactions per second and flags suspicious ones in real time, stopping fraud before it happens. Credit scoring. AI assesses loan applications using more data points than traditional methods, faster decisions, and more accurate risk assessment. Chatbots. AI-powered chatbots handle customer queries 24/7, reducing staff workload and improving response time. AI in banking, how it changes banking. 1. Automated operations. Routine tasks like data entry, KYC verification, and report generation are done by AI, freeing humans for complex work. 2. Cost reduction. AI replaces repetitive manual work. Banks save significantly on operational costs. 3. Enhanced security. AI monitors user behavior patterns. If your account acts unusually, it raises an alert instantly. 4. Better decisions. AI analyzes large datasets to help managers make faster, more accurate lending and investment decisions. 5. Compliance. AI automatically checks transactions against regulatory rules, reducing compliance errors and penalties. Blockchain. Meaning. Blockchain is a digital technology where data is stored in a chain of blocks, each block containing transaction records. Once added, a block cannot be altered, making it permanently secure. Word. Block equals a unit of data. Chain equals these units linked together. Blockchain equals a chain of data blocks forming a permanent, tamper-proof record. How it works. A transaction is recorded in a block. Multiple computers, nodes, verify it. Once verified, the block is added to the chain, visible to all participants, changeable by none. Key features. Decentralized, no single authority controls it. Transparent, all participants can see records. Immutable, data cannot be changed or deleted once recorded. Blockchain. Use cases in banking. 1. Cross-border payments. Instant, low-cost international transfers. Eliminates slow, swift processes and high bank fees. 2. Smart contracts. Agreements encoded in blockchain auto-execute when conditions are met, e.g., loan released automatically when KYC passes. 3. Trade finance. Digitizes documents like letters of credit, reduces paperwork, fraud, and processing time in import-export. 4. KYC management. Customer KYC stored on blockchain can be shared securely across banks. No duplication. Faster account opening. 5. Fraud prevention. Every transaction is permanently recorded. Fraudulent alterations are impossible to hide. Skill development questions. 1. Refer RBI website and identify the different types of banks operating in India. 2. Visit any public sector bank and discuss with the branch manager about the role and functions as a paying and collecting banker. 3. Collect and fill dummy account opening forms as different types of customer. 4. Draft specimen of negotiable instruments, bill of exchange, promissory notes, and checks. You've completed this chapter. Thank you for watching. Thumbs up, like, bell, subscribe, memo, share with classmates. Ria's notes.